Welcome back to your Mortgage Insider Update. Wowzers, the Fed came and spoke, and the markets reacted in a super positive way. A huge drop. I mean, one of the largest reductions in overall interest cost post a Fed meeting in a really long time. So we're going to jump right into the charts today. Positive news as Fed Chairman Powell came back with no rate hikes and projected rate cuts starting in 2024. So let's see what the market did. So this week we start with the 10-year Treasury is down below 4% at 3.953%. That is a huge drop. Wasn't that long ago we saw the 10-year Treasury up at 5%, and now we've blown right through the 4% number as we get back to the middle of last week. This was basically the day of the Fed announcement and just an improvement, and then it's sustained improvement, which is what we want to see. Major news there is that we're below the 200-day moving average. So you can see the 25-day average has started to turn over significantly. It's crossed below the 100-day average here, then the 50-day average. You know, these are going to all be really ceilings for rates to likely not go above those numbers as we start to gain traction here. So as we go back 6 months, we can see a little bit larger chart on where we stand right now at just below 4% at 3.92% today. If we go back to July, now this doesn't mean interest rates have significantly fallen below the lows of this year, but we've definitely taken a huge step in the right direction to get us back on track. So if you recall, back in July, interest rates started that climb. We had a pause in September, and then just the run up. This is the whole point here, is just to see how significantly the change has been, both on the hard side going up, which hurts really bad. Now with it coming down, I mean, that's a pretty substantial drop. We will take a look a little bit farther back at the 1 year look. We have not made it back to what would have been a high back at the beginning of 2023 right here. We're just below that level, but not nearly as low as we were back in April. So this was when it first started talking about, the consumer price index was turning over and inflation seemed to have been taken care of. That was wishful thinking, because we saw the interest rates did steady out at that point, and then they started their terror running higher. So with today's rates, we can see below 7% rates, 6.9%, 6.8% at the end of last week is a great thing as we approach the end of this year. Quickly, we'll look at the mortgage-backed securities. Mortgage-backed securities, just for context here, as the price goes up, the interest rate to the consumer drops. So as interest rates to consumers drop, that's seen in a higher price to investors purchasing these mortgage-backed securities. So this had been just over the 200-day average back at the end of November, right as we got the jobs report a couple weeks ago, and now we've had the Fed meeting. Just sustained higher prices. This means that mortgage companies can sell their mortgage-backed securities and get a decent price, which means they can offer their consumers much lower interest rates. As always, we're going to keep a hold of this roller coaster for you and bring back updates from time to time. So really appreciate you watching this video. Give us a like if you can give us a thumbs up here on YouTube, and we'll keep these YouTube updates coming every single week. If you're interested, you could subscribe to the page. Our newsletter will go out depending on who you are. We do a weekly video and a weekly newsletter to our real estate professionals. So anyone that wants more information or less information, please just let us know, and we can either include you more often or less often with the updates. Have yourself a great week, and Merry Christmas.